Welcome, ladies and gentlemen, from me, Guy Munson, to our regular 6-minute strategy summary. First of all, from all of us here at Saracen, our hearts are with our Ukrainian friends and allies today in their hour of need. Probably the best parallel with the invasion of Ukraine are the events of 9/11, a single event that determined government, foreign and military policies for years ahead. Today's brutal invasion will mean a massive rise in European defence spending, a scramble for energy self-sufficiency and a splintering of global supply chains. Geopolitically, there are further risks of escalation. Poland, Hungary and 5 other NATO members would now border a new, potentially expanded Russia. In short, the whole defence architecture of Europe has been rewritten. To date, the invasion has not too severely affected world markets. Yes, volatility has been high, but world equities are actually higher than they were a week ago. Extraordinary. The dollar has appreciated only modestly, global gold has climbed a little, and credit spreads have widened, but not significantly. Such a comparatively sanguine response to such an appalling geopolitical shock is not historically unusual, as it turns out. Markets tend, ironically, to rise in the aftermath of military conflict. We'll look in the slides ahead at whether this can't continue, what the catastrophic falls in the Russian market mean, and what all of this implies for global asset allocation. So let's begin by looking at the causes of the current crisis, particularly how NATO expanded eastwards. In the left-hand panel, I've shown the growth of membership from 1949 to the present day, and particularly the 15 new members that grew since the end of the Cold War. I've also shown in yellow aspiring members of NATO, including Ukraine and Georgia, which led to much of the current crisis as Russia felt encircled. You can also see that with an expanded Russian border, including Belarus and Ukraine potentially, how large the conflict risk is, and escalation risk is, for NATO members across the border. Let's begin by looking at some of the implications of the crisis now for Europe and the world economy. First of all, the extraordinary 51% of gas imports that Europe gets from Russia. It's even higher in some instances. North Macedonia, Finland, Latvia, Estonia, Bulgaria, all importing more than 70% of their needs. Could Europe survive the rest of the winter and the beginning of a summer from its current gas supplies? Well, Bruegel, the consultant in Europe, thinks just. If the EU is forced or willing to bear the cost, it should be possible to replace Russian gas already for next winter without economic activity being devastated, people freezing or electricity being disrupted. But on the ground, dozens of regulations will have to be revised and a lot of money quickly spent. So it's not clear yet, but if there was a sanction on European gas, perhaps Europe itself and the economy could continue. Secondly, let's look at trade effects. At just 2% of global GDP, Russia is not significant outside of energy. But do look at its trading partner, China, by far the largest partner to Russia. And this gives them some potential leverage. In addition, of course, they hold substantial amounts of Russia's foreign exchange reserves. So perhaps they are a credible negotiating partner. Thirdly, of course, the impact of the crisis already flowing into inflation figures around the world. On the left-hand side, I've shown since the beginning of 2020 the performance of nickel, wheat and oil, 3 great Russian exports, up 90%, 93% and 64% respectively, and those prices still continuing to rise. So this will put up global inflation rates, and currently we expect US inflation to now peak at 8% or even slightly higher. On the right-hand panel, I've shown the impact for food prices, and you can see the famous UN Global Food Price Index almost reaching its 2011 highs, exacerbated by what will be further supply restrictions from Ukraine, a big producer of cereals and sunflower oil. If we go through those 2011 highs, remember that was the time that produced maximum stress for the emerging world and in particular contributed to political uprisings in Libya and in Egypt. Let's take a look at the impact on the Russian domestic economy finally. US dollar per ruble collapsing there, you can see on the left-hand panel, and also MSCI Russia down by 60%, although of course many markets are closed, and going forward, FTSE and MSCI will exclude all Russian stocks from their index. On the right-hand panel, I've shown the composition of the Russian central bank reserves, and you can see the euro at 32% and the dollar at 16%, plus some sterling and other currencies, which are all effectively blocked. This makes it much more difficult for Russia to bring resources back home to defend its currency and financial markets. So a potentially very severe disruption of the Russian economy. What does this all mean for the world economy? Well, as you can see on the left, global PMIs, that's business sentiment, was already rolling over in the run-up to the crisis, with quite large regional falls you can see on the right, particularly in China and in India. The IMF, though, still predicting a growth of 4.4%, down from 4.9%, but that is an extremely strong number. So at the moment, there is no, in our view, risk of global recession. But of course, as the crisis went on, if energy prices were elevated for a long period, that thinking begins to change. What does this mean for equity prices? Well, I've shown here, as I indicated earlier in the talk, the performance of the S&P 500 in the 6 months following a military conflict. I've shown it for the Gulf War, for the Iraq War, for Russia's invasion of Crimea in 2014, for the Vietnam War in 1964, and the Afghan War in 2001. Extraordinarily, in all cases, the indices are actually higher than they were at the outbreak of the conflict. And for many of the indices, they were higher even after the first month. You can see the dotted line for the Russia-Ukraine crisis beginning to fall in that pattern. So ironically, of course, it does seem that actually stock markets do relatively well, or at least remain stable, in a post-conflict environment. So let's wrap this all up and look at the implications for the global economy. With inflation already at a 40-year high, we expect oil to average about $110 for this year, and that'll mean US inflation peaks around 8%, with similar numbers in Europe and the UK. Secondly, interest rates will still be put through, but we don't expect that 50 basis point rise in the US in March. 4 to 5 rate rises for the US, 3 for the UK, none in the Eurozone. We expect central banks to go ahead and dial back their QE and introduce quantitative tightening, the Bank of England beginning in Q2, the Fed in Q3, and the ECB ceasing bond purchases at the end of the year. But those will be very data dependent, and central banks have been clear how sensitive they will be in withdrawing liquidity. I've covered the geopolitical, trade and other implications. What about asset allocation? We're remaining neutral equities, underweight bonds and credit. We have no direct Russian exposure, and cautious on EM bonds overall. We've got a precautionary cash position, portfolio insurance where appropriate, and of course significant holdings of gold, as well as renewables and infrastructure. I hope that gives you some clear idea of our policy. We will of course be looking at the risks as we go forward from here, particularly energy, military, the risks of a global recession if this is dragged out, and of course higher inflation. Well, these are all very preliminary thoughts. I hope they assist you in your thinking back at home. And in the meanwhile, once again, our hearts go out to our Ukrainian allies and friends. Thank you.